Hello, everyone. Welcome to this special flash webinar, where we'll go over the upcoming IPO of Ant Group, the China-based fintech powerhouse that's set to become the world's largest IPO, potentially. For this discussion today, I'm joined by insight providers Arun George and Victor Galliano. Welcome, gentlemen. They have been following the IPO and the broader space around fintech and payments. Before we get into it, some quick housekeeping. You're very welcome to send your questions for our speakers using the Q&A button on your screen. Please do not reshare or reproduce the contents of this webinar without express permission. We will have a recording of the webinar available on the registration page afterwards. With that, gentlemen, there's no way to get started rather than get right into it. So I would like to start by getting a bit of an overview on Ant Group. Everyone knows Alipay, of course, but obviously that's not the only business that's at the core of the company. So maybe let's get a bit of an overview on the company, and maybe we can start with you, Arun.
Sure. Well, I'm sure a lot of people on this call already know Ant, so I'm going to try to summarize as quickly as possible about the business. So Ant has two operating segments, which is a digital payment services and digital financial services. These services are primarily offered through the Alipay app, Michael, as you alluded to. The digital payments are the foundational infrastructure that attracts online and offline customers by enabling most use cases on the Alipay platform, right? The beauty is just then they try to monetize those users by digital financial services, which through their credit tech, invest tech, and insure tech product segments, right? So these provide a wide range of services to the captive Alipay user base to drive user engagement, retention, and ultimately monetization. So they've created this quite nice virtuous cycle. I mean, I generally don't like to use that catchphrase, but I think in this case it's quite appropriate. Between a digital payments and a digital finance, which fuels growth and ultimately operating leverage. So that's a really quick summary. If you want me to go into the revenue models of each of these segments, I'm happy to. So Michael, just let me know.
Yeah, I think that could be useful, and especially as it relates to Ant Group really kind of turning kind of the bank model on its head, really, and kind of providing these full range of services.
Yeah. So I mean, I just want to quickly touch on the revenue model of each of these segments, right? So the revenue from the digital payments is really generated from two sources. First is the transaction fees that are based on a percentage of the total transaction amount for payments that are made through the platform. Okay, this is kind of the bread and butter revenue model that pretty much most payment providers use. The second is the interest income derived from settlement reserve funds. This is quite a small portion of revenue. The bulk of the revenue from the digital payments, I believe, comes from transaction fees. Now, moving on to the digital finance business, right? So you have three product segments in there. The largest of which is credit tech, which accounted for 62% of digital finance revenue. So the model here is that Ant originates loans, which are then independently underwritten by partner financial institutions. So as of June of 2020, it says that 98% of the credit balance originated through the platform was underwritten by partner financial institutions or securitized. So in either word, only 2% of that loan sits on the balance sheet of Ant at the moment. So revenue here is derived from technology service fees that are paid by these partner financial institutions. And that service fees are based on a ratio or based on a ratio that is determined on the credit balance originated to the platform. Now, if you go to the second largest segment there in digital finance is investment tech, which is about 25% of digital finance revenue. Now, what the Invest Tech platform does is it just lets partner asset managers to provide funds or investment options with low minimum investment amounts to consumers on the Alipay platform, right? Now, revenue here is derived from, again, what they call technology service fees that the partner financial institutions pay based on the volume of investment products that are sold through the platform. So again, it's just a percentage cut. The final product segment is Insure Tech, which is about 13% of digital finance revenue. Insure Tech basically lets in partner insurers to offer a wide range of insurance products covering life, health, P&C insurance areas, for example. Here again, and receives a technology service fee, which is based on the cut of the premiums that are sold to the platform. So, I mean, on the surface, it's like very straightforward. I mean, it is essentially enabling a lot of partners or third parties to sell their products to Alipay users, and it gets a cut of usually the amount of value of the product sold on the platform. So that's the best way to understand it.
Yeah, thanks for that overview. I think really it's one of the few fintech companies in the world, at least at this size, that can claim to provide this full range of services that one would expect from more traditional banking institutions, and also kind of being profitable while doing it. I'm not sure if you have something to add to that, Victor.
Yeah, sure. I think that the critical point here is that what Ant Group is, and looking at its origins, what it's done, and what its owners have been very clever about, is we all know the story that it's created the largest trusted digital payment system in China, and obviously, I think what they've done is they've attacked that area within the entire banking ecosphere where the economics was least interesting to the banks and most relevant to its prior parent, Alibaba. So, the banks let Ant Group, Alipay, get on with it. And what they've done with that is, they've been very clever with that, primarily, and I think the sort of secret weapon in here really is the credit scoring model, which in credit tech is the base for not only delivering the source of new loans or the demand for loans to the banks outside of their branch network, outside of their own digital platforms, but also gives the banks really more and valuable in-house big data that rests and lives within Alipay and Ant Group now. So that means that actually this is a springboard for Ant Group to really have bargaining power with those banks, not just in terms of where it's sourcing those loans, but hey, I'm giving you some more information here. It's not just the public credit records, but it's our own in-house credit scoring derived from what we see these anonymous consumers doing, what we see these anonymized merchants doing. So that has given them a very strong platform there, and in investment credit, investment tech as well has given them the platform to source potentially which consumer customers have the resources to invest and really that sort of information. So it's, when you look at it and you break it down and you look at the economics, in other words, in terms of the take rates of each of the business segments, when you look at payments, the payments business is very, very skewed, and there's a lot of free payments that go on there on a peer-to-peer basis. So actually, take rates are very low, especially when you compare this at an international level. So, if you've got PayPal with a take rate of 2.5% and compare that to Ant Group, Alipay, with 5 basis points, that gives you an idea of the weight of those peer-to-peer payments. But the value that resides in there really is so much more the data that is being collected and collated by the group. And you look at the economics in terms of an effective. I look at a sort of take rate on the lending side, the credit tech. It's about 2.7% of those credit balances that is being retained by Ant Group, which is very attractive. And in Insure Tech, which I think is a long run growth factor, it'll be a slower burn to begin with, but their take rate on that is in excess of 25%, which is very, very attractive. And in investment tech, it's probably about 60 basis points, but that's across the board for in-house and third-party funds. But I think what's really valuable here is that generally those main points, plus also they are sourcing business for traditional finance institutions that really don't have the reach that they have digitally. And on that basis, they're not directly competing with those traditional funds. So it's a very smart model.
Yeah, I would concur. I mean, you hit a lot of valuable points there, Victor. And coming back to, I would just pick up on two things. One is the point about the credit model, where you clearly highlighted the key competitive advantage there, where they can have a very robust credit score, that they can make these used consumer finance loans and have very low risk of it. And that also feeds through its digital payments business. If you look at the merchant fraud loss rate there, it is the lowest in the world. It's better than PayPal. So that again is the internal credit scoring model there, making sure that even if this business is very low margin, you can almost call it a loss leader because they give Alibaba favorable rates. It is a very low risk model, which lets them build the whole digital finance, which Victor was alluding to, that ultimately is the growth engine and profit engine.
Yeah, that's right. I mean, there's very little credit risk that is retained within the business. So, although in the second quarter you saw, PayPal and names like Square increasing their provisioning that they had to do on their relatively small but growing lending business, that has been a concern, and especially on SMBs, which is not something that Ant Group will need to worry about. I think they retain something like 2% of all the loans that they source. It's 98%. I think
that's right. That's
yeah.
right.
Yeah, and all this, of course, kind of lends to the market enthusiasm that we've seen for this IPO, which, of course, yeah, Ant Group is planning to list in Shanghai and Hong Kong. We have seen the likes of Goldman Sachs getting in there. So I think maybe we can tackle the valuation question. Both of you have written about it in your insights. So what is your view, especially after these latest developments?
Victor, do you want to go first? And I can.
Yeah, I'm absolutely happy to go first on that. In terms of valuation, I think what I did in my notes at the end of August really was say, okay, let's break this down into the constituent parts, and look at what these businesses globally are valued at. What are the comparables here? And it's a tough one because really there's no comparable to Ant Group, but you can pick and look at the different businesses out there. So in payments, what I did was I looked primarily at PayPal, and although, as I stressed earlier, you look at the take rate of PayPal and it's significantly higher than by many multiples than that of Alipay and Ant Group. What we did was we looked at the relationship between market cap to total purchased volume, the TPV, and we also looked at the take rate. And in the case of PayPal, it's approximately 10 times. So we applied that 10 times multiple really to the payments business of Ant Group. And so it gave us a market cap to TPV of 0.5%, 0.47, which gave us a valuation of about $80 billion for that. In terms of investment tech AUM, we consider that potentially the biggest business from a sum of the parts value going forward. It's a lot bigger at this point in terms of valuation than the credit tech business. Our rationale there is looking again at other wealth managers like the Lansdowns of this world, Hargreaves Lansdown here in the UK, but also looking at I think a bigger comparable that gives you a tremendous, the sense of how big the opportunity is here, is something like XP in Brazil, which is listed on NASDAQ and was listed from December of last year. And they have a market cap to AUM of over 30%. So we applied a discount to this because obviously, I mean, the thing with XP is utterly dominant in the Brazilian market. So I think Ant Group, although it is the leader in this investment tech sphere in China, we see that it has potentially more competition here. And so we applied a sort of discounted market cap to AUM of about 21%, which gives you a massive value there of 125 billion. That gives you the bulk of the value for the business. Credit tech, and I think here I'm potentially being too conservative. What we did is we looked at a market cap to loans valuation, and we gave it a market cap to loans valuation of 12%, which is a slight discount here, a slight premium, I apologize, to the 7 largest banks in China by market cap. So they have a market cap to loans ratio of about 10%. So it's a 20% premium to those. It's a big discount. If you look at something like, for example, the digital bank in Brazil, Banco Inter, which is a medium-sized digital bank, that will be trading at a market cap to loans ratio of probably about 25-30% after the recent correction we've had. So it's still at a big discount to names like that. And one needs to work in there, I think, the value of the secret weapon that I described earlier, which is the credit scoring model. So I think potentially that's conservative. Also on Insure Tech, we applied a market cap to premiums similar to Ping An, 250%, 2.5 times, which gives it a value of nearly 20 billion. So we came to a sort of base case valuation here of about 260 billion. We flexed that a bit, and we got a bear case, similar metrics, but a bear case of 210 and a bull case of just over 300, which sort of sits within that range that the financial press has been talking about of 200 to 300 billion. I'll leave it then and let Arun talk us through his valuations.
Yeah, so it's very similar to yours, but I mean, you effectively use the sum of the parts, which is, because of its varied businesses, is the most appropriate valuation method, right? Now the question comes is, how do you do the sum of the parts? And Victor, he's done it in I would say, quite a refreshing and unique way in terms of looking at almost KPIs and valuing the company, the different business segments based on those KPIs. The way I did it is I essentially looked at the different businesses and valued it, and I estimated what the forecasted earnings would be for 2020 and 2021. That's typically what I do. And then I also make assumptions on what the typical profits would be of these operating segments. And for each of these segments, I've taken a peer group. So for example, the digital payments business, I took a peer group of all the payment processors like PayPal, Square, Stone, for example. For credit tech, I took instead of the banks, I took all the Chinese online consumer finance companies like Lex and FinTech, 360 Finance, for example, which I think are more appropriate comparators because they're effectively similar business models. For investment tech, like Vector, I used a couple of the UK companies and some Asian, so UK companies like Hargreaves Lansdowne, AJ Bell, because these are effectively online wealth management businesses. And then Chinese businesses that have online wealth management offerings like Futu Holdings, for example. So I use that as my peer group for the Investec business. For Insure Tech, it was quite hard to really find a peer group for that. So I just assumed a similar rating as investment tech. That's what my assumption there. So you kind of add up everything, and ultimately my post-money valuation was about 250 million. So somewhere in between the rumored valuation range of 200 to 300 million market cap. Now the complication with this valuation or this SOTP model is, the first to admit is, unhelpfully and doesn't disclose the profitability by operating segments, right? So that makes a huge difference because fundamentally the digital payments business, because of the low take rates, is actually quite a low margin business. And I think it's a bit, I would say always naughty of Ant not to disclose the operating profit by operating segments, because it says that you can't really do it because the S&M and R&D expenses are shared across the different segments. But a number of companies have that issue, but they still at least try to disclose gross profit, for example. So I think it does it on purpose because it doesn't really want to disclose how low profit, what a low margin business digital payments is.
Yeah, sorry if I could just sort of dive in there. I mean, in terms of the payments side of things, I reckon we saw a big change in, I believe it was 2017, 2018, with the banks charging much higher transaction fees, which has hurt the profitability of that business. But what's interesting there, I think, is that if you look at the kind of growth, you can arrive at a gross margin as you've done, Arun, and we've looked at as well. Probably for the first half of maybe 13%, something like that. But if you think, that was adversely impacted by, obviously the downturn, the COVID-19, then maybe you could look at a sort of 15% growth margin, maybe a bit more for the second half. And what we do know from PayPal is, their EBITDA margin is about 18, 19%. So it's not a million miles away from that. It is lower than that. And obviously that's a gross margin, so there are other costs in there. Yeah, it would be extremely helpful to get some sort of indication on profitability, even if you had to allocate some costs, as you say, across the SMB and consumer credit businesses.
Yeah, Victor, just to jump in, the other issue with why the margins are quite low in the digital payments business is there were regulations that prevented them from earning interest income on balances.
Yes.
And that was put in place.
Correct.
I think it was end of 2008. I can't have to check it out, but that was a big issue for them too.
Yeah, absolutely. Yeah. So, I mean, the one thing I would add to my valuation is that I did sort of sanity check this. I did do forecasts as well on the overall business, like Arun, to 20 and 2021, and sanity check that in terms of pegs. And the peg ratios were obviously more attractive at a lower valuation. We're looking at a peg ratio on the conservative case, the bear case, if you like, of 0.74, and on the bull case a PEG ratio of 1.1, and on the base case 0.9. So it's kind
Victor,
of there, but it's sort of below 1 times. Sorry,
Victor, what was your PE for 2021?
Bear with me for a second here as I go. Right. My PE for 2021, and this is based on an Ant Group valuation, which is my base case, which came to about 259, call it 260 billion. I had a PE of 25.8 times for 2021.
Okay, so it's very similar to mine, which was
right.
24.9.
Okay.
I guess great minds think alike. But what's interesting is, coming to the Victor's point about sanity check, right? So, I'm sure there are lots of people having different ways to value it. And all of them are right and wrong in their own ways, right?
Yeah.
But ultimately, I think a sanity check is important. And one of the key things was that for me is like, if you go for the maximum market cap range that you're talking about, which is 300 billion, according to my forecast, that's about a 30 times PE on a 2021, right? That is kind of very sensible if you look at the median Chinese tech mega cap. So if you know the Tencents of the world, JDs of the world, for example, their median PE for 2021 is 32 times, right? So in that sense, Ant is, I think, even a $300 billion valuation is not blue sky or completely ridiculous. Yeah.
No, absolutely. And if you look at names like, bringing it into the sort of international perspective of payments, the PE for 2021 for PayPal is, 41 times. For Stone Co., which is Brazil, growth, but smaller, but much higher take rates, 50 times. Visa, again, this is more a banner, a network, 34 times. And in the small cap space in payments, you've got Nexi, which is Italy, at 31 times.
So I guess in this frame, what are the risks then? Like what could mar the picture, I guess? Because so far it all looks pretty attractive, I would say.
Well, I think, Victor, if you're happy, I'll go first.
Yeah, please.
For me, I think, if I look at it, there are really two risks to the story, right? As I alluded and Victor also mentioned, Ant says that they take very little risk on the balance sheet for a credit tech business. Only 2% of the loans are self-operated or are on the balance sheet. But the bears would say that that's not actually, while technically true, that's not really reality. Because what's interesting is that most of the loans, or at least a good chunk of the loans in the credit tech business, is done through a company called MyBank, which is an associate of Ant. Ant was a 30% equity interest in MyBank. MyBank shares a lot of senior management with Ant. So MyBank is the most important partner in the credit tech business. Now, what the MyBank provides to Ant is it possesses all the necessary licenses and permits to operate a credit tech business, to essentially take loans. So now what the issue is if the economy doesn't recover, doesn't normalize, it starts trending downturn, and there's an increase in or a significant spike in delinquency rates, Ant may need to bail out MyBank, right? In addition, MyBank is a commercial bank, so it's subject to capital requirements under the regulatory laws. And it's not very apparent who the other shareholders of MyBank are, how connected they are to the Alibaba and ecosystem. But if things go bad, Ant can't sit around and say, oh, look, we have only 2% of loans on the balance, it is still on the hook to save my bank and give it some sort of capital injection, right? So I think that's where the indirect risk comes in. And also, I think quite recently on 20th of August, China's Supreme People's Court announced a decision to lower the cap for private lending rates. So basically, they've said that the default, the annual percentage rates for such loans cannot exceed 4 times that of the China's benchmark 1-year loan prime rates. So based on the last published rate, the cap is about 15.4%. Now, the ruling is a bit inconsistent because it doesn't actually say if licensed small loan companies qualify as these licensed financial institutions, right? Because Ant has subsidiaries, small loan subsidiaries, and it's also not clear how much of Ant's loans that are given by my bank and its other partners exceed the 15.4% threshold. So this is, this is also a risk. I mean, Ant doesn't really say much in his filing about it, other than mention it. So that's something that investors also could be a bit concerned about. But having said all this, if you look at the bigger picture, right, I don't think it's in the interest of the Chinese authorities to really put in place or announce new regulations or rules at this stage to derail the IPO, right? This is a big deal for them. So they're going to make sure that this goes smoothly. Victor, do you have any thoughts on?
Yeah, yes, thank you. Just to add on that, really, I suppose stating the obvious a bit, which is competition, is one of those areas that obviously this is not going to be just Ant Group's playground. There will be others in the sandbox, other big names that are, and I think the threat comes more domestically from tech fin rather than fintech. It's those other tech names, JD.com, Xiaomi, who are also, going to be leveraging up their big data lakes to get into this business and get a slice of the action. I think also, and this is more, I think, potentially an esoteric risk, but something that the People's Bank of China is looking at, the digital currency, electronic payments, is that going to be a competitor, if you like, in the payment space? A bit like we're seeing with the Central Bank of Brazil and the PIX payment, which is a peer-to-peer payment technology that's being developed there. And, in the case of Ant Group, is that something that could potentially take away from all that peer-to-peer data flow? And then there are the obvious risks, a heightened geopolitical risk, between China and the US. Although to some extent, Ant should be shielded from that by doing a Shanghai and Hong Kong, listing there. But and finally, I think one last point is something that Arun, I think, raised in his last piece, and looking at sort of Ant Group and ESG and focusing on the G, those shareholder changes that we saw recently, and I think those were very well covered by Arun in his last piece. So those will be questions that will be thrown at them, and they need to have some clear answers on.
Arun, do you want to add anything to that last part, or have you sort of covered what you wanted?
Yeah, I've covered that in the risk. In terms of the shareholder ownership structure, right? I think it's part and parcel of investing in Chinese companies. It's very rare you'll find a clean shareholder structure, and this has been known for a long time in terms of how Jack Ma effectively controls the company. So yes, the shareholding structure has moved around to the benefit of insiders, but as far as the outside investor is concerned, it's still the same. Jack Ma calls the shots.
and yeah, I mean, the latest IPO he was a part of has done pretty well. So
That's correct.
so so we have a little bit more time. So I want to take a question from the audience. So I guess, and that's one of the risks that could be addressed, is that Ant's business is basically fully in China, correct? So it doesn't really do business with companies outside, like payment companies in the US, or routing payments towards the US.
I mean, I think it has a small presence outside of China, but I think that, you know, the growth opportunity is for them within China. It has some, correct me if I'm wrong, Arun, but I think it has some subsidiaries in Europe, Africa, other parts of Asia. But primarily, I suppose the Alibaba ecosphere, you know, one can access globally. And then, although it's separate from Alibaba now as Ant Group, but that Alipay is obviously, you know, a global payment technology, right, if you like, or payment service. But it's not. I don't think it's well used in the US, or hardly used. Is my
Yeah, I mean, the Ant strategy is kind of clever, right? So it doesn't want to, it doesn't really want to be upfront in the radar of Western governments. And it mostly sees the opportunity really in the rest of Asia. So what it does is its strategy is to really take stakes in and back the winning horse in different markets, right? So one of its most visible investments is in India, where it has a stake in Paytm. So, you know, Paytm is fighting a battle there to be the dominant player, and that's really Ant's strategy per se. It does a bit of cross-border transactions, but it's really not too much. You know, for example, it actually discloses its international TPV, or transaction volume, only for the first half of this year, and it's just less than 1% of its volume it does in China. So it's really not. I wouldn't really consider it to be a growth engine. Where it's going to be really delivering value for shareholders is it backs the right horse through investments, which eventually are realized through IPOs or trade sales.
Yeah, Paytm is quite a good. You know, it's quite a major player in payments in India. Who's the other partner there, Arun? And who's the big shareholder there, so to speak, in Paytm?
I'm not aware. I mean, I'm not sure who it is.
Right, but it'll be a local domestic player. So I think that, I mean, is it fair to say that kind of the Ant Group strategy is very much, you know, obviously China is our base, our strong base. We will move from there into other parts of Asia as and when we see the opportunity, but we will not take outsized risk there. And, you know, if the opportunity is a big and attractive one, we will partner up locally. So does that kind of make sense in terms of their strategy, or do you think it's more ambitious than that?
No, I think that strategy makes sense because, you know, if you remember, it tried to buy MoneyGram and was blocked by the US. Yeah. So I think it's learned its lessons there, especially now with the sentiment. Generally, most Western governments are being very protective of their local champions.
Yes.
So I think the strategy really is to remain under the radar, take stakes. There's plenty of headroom to grow the business in China. So let's focus on that, at least for the time being.
I'll take one last question from the audience, which focuses on credit tech. So since recent revenue growth has seemed to be driven very much by that segment, and considering that the PBOC asked their partner banks to review their joint lending books, is there some limit to credit tech getting bigger? Is that segment sustainable in that respect?
I think, sorry if I can just make a comment there. I mean, in terms of the growth opportunity there, I think there's still a lot of room. There's still a lot of room to grow. If you look at consumer credit balances in China, it's 13 trillion yuan. SMB credit balance is 6 trillion. Their share of that in Ant Group at combined, and these are year-end 2019 numbers, it looks like about 10%. So that there's still scope to grow there. That makes them, quite big. But I think the bottom line here is even if the growth opportunity is not that great, I think Ant will retain its bargaining power in that business, and that is through the credit scoring service, and I think that's a very, very valuable and powerful tool. But there's still, I think, a lot of potential for growth in that area. I mean, I've been more conservative in valuing my valuation on a sum of the parts basis, but probably I think there's upside to that valuation, even if we have sort of slower credit growth. The big risk really is what Arun mentioned earlier, and the risks, which I think is that the macro turns south. There's not so much demand for loans, but also there's less risk appetite on the part of the banks to take on those risks. Arun, sorry.
No, I agree with that. That's perfect. Exactly the points. And the only thing I would add is because the regulations are tightening the noose against in terms of lending rates practices, a lot of the market is consolidating, right? And it generally consolidates around the large players. And one of the largest out there is credit tech business, right? So if anything, Ant should benefit with this ongoing consolidation.
Well, that's just about all the time we have today. So thank you very much both for your thoughts. I think they're very interesting, and there's a lot to see yet with this IPO. Thank you everyone for being with us today. If you have any more questions, please send them through to research@smartkarma.com. And if you want to get in touch directly with Arun and Victor, please reach out to your Smartkarma account manager. Thank you, gentlemen, very much once again, and have a nice day.
Thank you.
Thank you.
Thanks very much. Bye.